Hi, good morning, clients. Sorry to keep all of you waiting as we were having some technical difficulties. Without further ado, I think we can start today's morning call. And today what we have lined up is we will have a company update on Capitaland Commercial Trust after a divestment last Friday. And then we will update on a site visit note we published last week on Sasseur REIT, followed by some sector updates on property and banking as well. First off, I'll touch on Capitaland Commercial Trust. And what happened to this REIT is that on Friday, they announced the divestment of 20 Anson. So what is the news on Friday is that the sale of 20 Anson will be for 516 million. And this price will be at 19% above the valuation as of 31st December 17. And this is what is carried on the books as well. So how much 20 Anson accounts for in CCT's portfolio is that in FY17's MPI, 20 Anson accounted for 5.5% of the FY17 MPI. The divestment is expected to complete in the third quarter of this year, and proceeds are most likely to be used to firstly pay down debt and secondly to fund future acquisitions. What we think of the divestment and some of the positives we think coming out of it is that at an exit rate of 516 million, this translates to an exit yield of 2.7%. And this exit yield, when you compare it with the divestments that CCT had made in 2017, those yields were at 3.2% to 3.4%. And so this one will compare more favorably versus those two divestments that they had in 2017. If you were to recall, these 2 years have been a busy 2 years for CCT. They have had numerous divestments, acquisitions. In 2017, they had the divestment of 1 George Street. They had the divestment of Wilkie Edge. Now 20 Anson. And then in between, they had the acquisition of Asia Square Tower 2 as well. And they also had the acquisition of the Germany office building. So you see that the management has been very busy, very active in rejuvenating, reconstituting the portfolio. And I think what you're seeing in this divestment this time around is that the exit yield is lower. And I think this is a further demonstration and a further showcasing of management's ability to rejuvenate and recycle portfolio, because effectively, if you look at the acquisition they had last year, the yield was at 3.6%. So effectively, they are divesting assets with lower yielding assets and reinvesting the capital into higher yielding assets. And I would also say that the acquisitions, the new buildings that they have acquired, if you look at Asia Square Tower 2, in the Marina Bay area, up and coming area, and the land lease remaining for the acquisition is also not shorter than the divested buildings. So you have similar land tenures in an area which is more up and coming. So the potential for growth is also higher. And you see that acquisition at 3.6%, for example, for Asia Square Tower 2, 3.6% was just based on an occupancy of 88% thereabouts. And what this means is that there could be further upside if occupancy further ramps up. So there could be an improvement to the 3.6% that they acquired the building at, versus this time around 20 Anson exit yield 2.7%, but this is on a higher occupancy of about 92 to 93%. And if you were to recall the total ownership period of 20 Anson, CCT bought this building in 2012. They bought it for about 420 to 30 million. That time, the yield was about 4%. And over this 6-year period, annually collecting 4% thereabouts MPI yield. And then at the end of this 6-year period, selling it for 516 million, you see that the IRR achieved over the 6-year period is pretty decent at about 7%. I'm talking about unlevered IRR. And this 7% would compare favorably versus the average cost of capital for CCT, which would come up to, I estimate would be about 4 plus 5% if you consider cost of debt to be about 3% where they're doing now, and cost of equity 5 plus 6%. So all in, with the proceeds coming in, if the proceeds were to be used to pay down debt, the gearing would be reduced from current is about 38%. It would be brought down to about 34%, and this would provide further firepower for the REIT to fund future growth. So all in all, we maintain our accumulate call on CCT. Our target price is unchanged at 188. We expect any loss of rental income from Q18 onwards, which is when the divestment is expected to be completed. We expect the loss of rental income to be topped up with the divestment proceeds, even though, as you can see from this line over here, the 20 Anson only accounts for about 5% of the previous year's MPI. So the loss of rental income would not be expected to cause a huge vacuum in earnings. And for CCT, I guess the main concern now could be on the interest rate hikes. And for CCT, I would say interest rate risks are pretty much mitigated because of a few factors. One of them is that this year there is no more debt expiring. The next expiry will be in FY19, and that is only 8%. So that's one. And number two is that out of all the debt that they have, 90% of the debt is on fixed rates. And we also expect CCT to benefit from the expected rising office rents due to the tapering supply in the next 2 years. And our expectation for office rents this year is to grow 5 to 10%, as we have already seen in the first quarter. It's already up 3.2% Q on Q. So next up, we will touch on Sasseur REIT on one of the site visit note we published last week. Just a little bit on the company background. This will be the first outlet mall REIT to be listed in Asia, and their initial portfolio will have 4 outlet malls, predominantly in fast-growing Tier 2 cities in China. And investment thesis for this REIT would be that they firstly are capitalizing on the fast-growing outlet mall industry in China. They also have presence in cities which are anticipated to grow the fastest out of all the cities in China. And lastly, in terms of how they structure the leases and how the system of rents is collected and paid out, they actually do have underlying supporting dynamics to capture upsides in revenue and at the same time mitigate risks on the downside. This is what I'll touch on and elaborate on later on. So the first thesis in the capitalizing on the fast-growing outlet mall industry in China, you can see that based on the China Insights Consultancy survey, the sales revenue for China outlet industry from 2016 to 2021, the CAGR is expected to be close to 24%. And you can see that this CAGR is at a much faster rate versus the traditional retail. As you all may already know, outlet mall industry is actually a pretty new industry in China. The first outlet mall was only opened in the early 2000s. And the growth of this outlet industry is actually backed by this strong growth in the disposable income of urban households in China. And you can see that in Tier 2 and lower tier cities, the disposable income is actually growing at a faster rate. Now, secondly, the 3 cities that Sasseur REIT is present in, they are present in Hefei, in Kunming, and Chongqing. You see that if you look at the top 10 cities in China with the fastest growth rates, these three cities are up there in the top 10. You have Hefei coming in number 3, Kunming at number 5. And if you look at the biggest markets in China, the top 10 biggest markets in addressable markets, this is Chongqing is part of the top 10 markets, and I would say among the top 10 markets, they are one of the fastest growing as well. Now, the underlying supporting dynamics to capture upside in revenue while mitigating risks is that, as we all have already seen in the charts, this is a fast-growing industry. So leases in the outlets are actually structured in such a way that there is a bulk majority of leases which are purely based on commissions. That means to say there is no fixed rents. And so what this does effectively is to allow the REITs to capitalize on the upsides in revenue. As the tenants grow their revenue, you know that rents will grow correspondingly. And now then the next thing to worry when so much of your leases are pegged based on revenue is that you have no fixed rents. And when you have no fixed rents, then your stability of the REIT that is desired by investors may not be there, because if sales growth slow, or when the industry strong growth tapers off, then you have it that the growth prospects or the stability of the revenue or the rental collected from the REITs may not be there. So how the REIT actually mitigates this risk is that for new outlets, the leases are slightly longer than the older outlets. So for newer outlets, the location or the mall is still in the novelty phase, where there's still a crowd pulling factor, but as the mall grows more mature and establishes a track record and attraction, then leases start to get shorter. And the significance of these shorter leases is that this allows management ample flexibility to tweak the tenant mix as and when they see that any particular sector or tenant is not doing well. For instance, if you look at the Chongqing Mall, which is the most established outlet for Sasseur, that mall, the average WALE is only close to about 1 year. And versus if you look at typically retail malls, regardless whether in China or Singapore, the average lease is about 3 years. So there is also a good mix of international and local brands. About 30% of all the brands are international brands. There is also minimal credit and counterparty risk, because the tenants are expected to deposit the cash collected at the end of every day to the REIT managers. And even for cashless sales, where the point of sales terminals, they are actually set up and established by the REIT itself. So all these cashless payments will also accrue to the REIT manager, and then they will deduct off the expenses, the rentals, before any residual income is brought back to the tenants within 45 days. These outlets mainly ride on the rising affluence of residents within the catchment area. And lastly, for one of the main fears in buying such luxury goods in China is that customers' fear of buying fake goods can be allayed, because there's a compensation policy where if you have found that you have bought a fake good within the mall, then you'll be entitled to a compensation of 10 times your purchase value. And these are some of the pictures that we took during the site visit. This is the Xi'an Mall. Is not part of the REIT yet, but it is within the sponsor's ROFO. And this is the main mall, the biggest one they have in Chongqing. And these are the machines that I talked about for depositing the money to the REIT manager at the end of the day. These are some of the tenant mix, and if you can focus on the first floor where the international brands are, you see the likes of Ferragamo, your Michael Kors, your Hugo Bosses, your Coach and all. as for peer comparison, there is no direct outlet mall REIT listed locally, but if you look at China-focused retail REITs, look as for instance, Capitaland Retail China, your BHG Dasin and the likes of Mapletree North Asia Com. These are trading between 6.5% yield to 8.5% yield. Okay, next up, we will also have some updates on the property sector. Last week, as you guys may already have known and heard the news about the confirmation of the 6 land sites for second half 2018. So these 6 land sites, out of which 2 are in the prime districts and 1 of which is an EC site, can potentially yield about 2,700 units, including 700 EC units. And with any concerns that investors may have with this EC site potential supply coming up, if we were to still look at this supply number at the end of first quarter 18, you see that this number at 52,000 is actually still one of the lowest, despite the ramp up in this GLSs and en blocks. This number is actually still at near to one of the lowest levels in, I would say, 10 years, since 2006. And if we were to map that supply against the trailing average annual demand, you will see that you have a supply demand ratio of about 2.7, and that is also one of the lowest, easily one of the lowest in the last 10 years. So if you compare current supply levels to historical levels, we are really nowhere near the peak. And we also met up with management for one of the developers recently, and some of the comments that we heard, we will share them now in that. So the thought is that why the property upcycle could still have legs is that, first of all, we are still pretty early in the upcycle phase. If you look at the historical upcycles that we had since 1990, you have it that the average that we have seen for a typical upcycle is about 16 quarters. And right now, where we stand is, since our recovery in the third quarter of 17, we are only into our third quarter of an upcycle. So you can say that we are still in the very, very infancy phases of property upcycle. And in terms of the affordability as well, if you were to track the affordability index, if you look at the median home prices versus the median household incomes, we had household incomes growing 4 to 5% since 2010. And but what we have seen is that since 2013, we have had our housing prices contract for 15 consecutive quarters. So with this rising household income and this contracting of home prices for 15 quarters since 2013, you have the price to income ratio, which is actually still a far cry from the peak in 2013 and 2010. So if we were to compare the number now versus the peak in 2013, let's say, there is still a scope for home prices to actually go up by 20 to 25% before we actually hit that kind of pricing levels. And okay, the next thing that was shared is that the construction sector could also be on the verge of turning up, because based on what the management has been seeing in terms of the tenders for the en bloc projects, that they've seen that some of these companies are not coming into tender, probably due to capacity concerns. And also one of the reasons that possibly could be for the slow sales, because in June we saw two projects being launched in the Serangoon area. One of them is by Oxley Affinity at Serangoon, and the other one by Keppel Wing Tai Garden Residences. Those the takeout rate for those two came in a bit shorter than expected, or a bit slower than what investors could be expecting. And one of the reasons shared for what management thought could be the reason was that the slow sales could be due to pricing. Okay, with that, I'll pass on to Paul to update on the banking sector.
Okay, thanks, To Hong. This is Paul here. I'm just filling in for Minion, our banking analyst, on the latest data that we got on Singapore banks. Okay, on Friday, basically they released the loans growth in Singapore. The May number saw loans grow 5.5%. But if you look at the second quarter to date of May, loans actually grew 5.6%. So what is positive is that this is an acceleration from first quarter's 4.8%. Another point to note was that housing loans and car loans also grew at a much faster pace. They are growing at their 3-year and also 5-year highs respectively. So this is a good indication that the domestic economy is gathering some momentum. In terms of the interest rates, that is another positive. We saw that the 3-month SIBOR is near 10-year highs, and it's up about 50 basis points year on year. Average SOR, which, as you all know, SOR is to price corporate loans. That actually rose even steeper and actually doubled year over year in the second quarter. And we expect further upside in interest rates. As we all know, there are 2 more Fed rate hikes priced in, especially after Friday's release of the Fed's favored gauge, which is the CPE price index, which is already close to their 2% inflation target. Okay, you move on to the next slide. In terms of, we also look at Hong Kong data. As you know, Hong Kong accounts for almost 1/3 for OCBC and also DBS. Okay, so in terms of loans, loans in Hong Kong for May actually slowed to 12%. But when you look at on the second quarter to date, it's actually up 14.5%, slight deceleration from the 15.7%. But even you look at it, when you compare the loans that's being registered out of Hong Kong, is obviously 2 or 3 times faster than Singapore. So that's a positive for banks that have exposure to Hong Kong. If you look at interest rates, similar to Singapore, the HIBOR is also at near 10-year highs. And again, there's a very sharp spike in HIBOR in Hong Kong, which is actually more than doubled, or actually 100 basis points year over year, or 65 basis points quarter on quarter. Again, the strong HIBOR and SIBOR will be supportive of net interest margins for the Singapore banks. On our final slide, this is just a snapshot. Asset quality, as you know, can be measured. There are many ways to measure, but we just take this as just as a barometer. When you look at the global jackups utilization rate, you can see the red line. It actually rose to 65%. This is a positive because it's the highest utilization in 2 years. But the problem is that blue line, as you can see, the day rates is still at decade lows. But I guess utilization is probably the lead indicator to average day rates, as you probably need utilization rates to rise before you can pull up the day rates. In terms of the SGX, this is another data point. There are 2 parts to the SGX data. Firstly is the derivatives volume, which is the DDAV. It comes out a bit later, comes a week later. So what we are saying now is up to May. The June number will only come out probably a week later. But anyway, up to May, there is slower derivatives volume. It is still growing about 7%, but it could not compare to the first quarter spike of 39%. In terms of SDAV, which is our SGX volume, again, because SGX only released the data about a week later, but we can use Bloomberg's number to have a rough sense of what the actual number will be. So it also slowed in the second quarter, but it still grew quite a respectable 9% in terms of SDAV. Again, these are all obviously off first quarter's very strong pace of growth, which are about 18%. But in general, second quarter should still be a respectable number for SGX. As you can see, the derivatives and securities volumes are up at high single digits. Okay, that's it for our slide. We are open to questions now.
Hi, there's a question on outlet malls. This so the difference in the difference between outlet malls and the typical malls that you see in Singapore or the typical malls in China is that these outlet malls, they tend to sell the off-season kind of stock for typically if you look at the luxury brands, if you have stock that is maybe 2 or 3 seasons ago, then these are what will be on sale in outlet malls. And because what the main boutiques will be carrying are the more the latest brands, the latest designs. So all these outdated designs will be brought over to outlet malls, and typically the discount can range from 30% to 70-80% from what we saw on the ground. And also I think the difference will also be in the leases that I have mentioned earlier on. Like in a typical mall, you have it that most of your leases will be fixed leases, fixed rents, subject to annual escalations, maybe a small percentage of gross turnover. But this one, in how this Sasseur REITs is the leases are structured, is actually mostly on percentage of revenue. Hi, I would also explain a little bit more on this chart on the supply versus trailing average annual demand. This is just a metric we look at to get a feel of how fast existing supply would be cleared out without any incremental supply. So if we base on current supply and if we base on historical take-up rate in a year, so historically take-up rate in a year is about 22,000. Then if you look at this number versus the average annual take-up rate, then you are looking at a supply of about 2.7 years, which means to say this is just a gauge as to how long the developers will need to take to clear the existing inventory. But of course, this is just based on the post GFC average annual demand. And for this, so this is from 2010, and in that 8-year period, you have the first 3 years being very buoyant, and thereafter the next 5 years being very sluggish. So if you were to take the last 1 year, for instance, right, the last 1 year's demand would be about 27,000. So last year we had 27,000 transactions in a year. And so if you use latest transaction figures, then this number could actually be smaller because of the ramp up in transaction volumes we've seen since the second half of last year. Hi, there's another question on the ongoing tariff dispute between US and China and whether this could have any impact on Sasseur. So far, what we've seen is that for textile products it's not been affected yet. So you have it that mostly what has been affected are your electronic products, your steel products. So on that front, there's not much impact that we can see of yet. And another question on our STI outlook, we still maintain our outlook call for STI. Okay, if there are no further questions, then I will end today's webinar here. Thank you all for tuning in, and we will see you guys next Monday again.